Hello and welcome to The Reluctant Investor, and to today's video, in which I'm going to be talking a little bit about the world of investing completely and utterly losing its mind. Yeah, that's right, in the week that I should make a YouTube channel about finance and investing, the world of investing has gone a little bit mad. Sort of apoplectic with rage on one side and giddy with excitement and joy on the other. So, whilst I said last week in my introductory video that the focus especially in the early videos, was just going to be on the absolute basics of investing and sort of short educational videos. That is still broadly the plan, but this story is a bit too big not to cover, and the few number of subscribers that I picked up last week, a number of them sort of DM'd me or commented saying, are you gonna cover this? So the reason this is such a big story is not specifically because it sort of changed the whole investing landscape or anything like that, or affected any of the major indices. I mean, it has slightly, but not in a huge way. It's more the ramifications of it, the number of people who have become interested in investing or have invested for the very first time, for a number of different reasons among different people. I'll come to that, but yeah, it's the sort of cut through that this story has had and what it might mean going forward. That means it's probably worth covering. And also, like I say, it is sort of relevant because a lot of beginner investors have become engaged with investing. So in a way, it's handy that this should come out when this channel is still in its infancy. I'm not going to go into the sort of details and minutiae of what's gone on. There's lots of videos out there explaining the intricacies of why what has happened. But in case any of you have completely missed this story, even though it has sort of broken through into mainstream news, essentially a number of hedge funds had heavily shorted a number of stocks, but primarily originally it started with a company called GameStop, which has lost money for the last 2 years, was expected to lose even more money over the next 12 months, and a number of hedge funds had really heavily shorted this stock to the extent that I believe it was 113% of the company was shorted, which might not make much sense, and in a way it actually doesn't make any sense. But in the future I'll make a video all about shorting and in more depth on that. But essentially all you need to know is these hedge funds were betting that the company's share price and valuation would go down based on the company's fundamentals, but they were doing it very aggressively. And a subreddit, which is like an online forum called Wall Street Bets, had noticed this trend and decided to cause some mischief and aggressively bought the stock, driving the share price up. And therefore the people who had shorted the stock were in a little bit of trouble, or a lot of trouble, as it transpired, given that it continued to skyrocket, and then there was a dip when a number of the trading platforms either restricted or temporarily halted buying of the shares, which was a little bit suspect, but again, slightly off topic. But and then it drove back up again. And I should say that by the time this video comes out on Monday, I'm recording this yesterday, on Sunday, it could have risen another 1,000%, or it could have gone back to where it was a week ago. It's an extremely volatile situation, and there isn't just GameStop. There's a number of other stocks that are included in this. There's BlackBerry, Nokia, a company called AMC. As you can tell, that they're all sort of very beaten down stocks that and companies where the prospects perhaps don't look that good. But anyway, I'm not going to go into, as I say, the details of what's actually gone on. There's lots of other people who've already done that since this story really kicked off on sort of Tuesday or Wednesday. So if you want to find that out, there are other places. Maybe another time I'll do it retrospectively. But instead, I'm going to try and continue to come at the story from a beginner's perspective by sort of looking at 5 big takeaways that, if you're looking at this story and you're a bit confused or you're relatively new to investing, what we can learn from it, and whether it's sort of changed the actual fundamentals of investing. So as I say, if you enjoyed the video, hit the subscribe button and give us a like. And without further ado, here are 5 big takeaways from the GameStop Reddit short squeeze. Number 1, the dangers of shorting a stock. Now, I thought I would start with this one because in many respects, this is why this is such a big story. That's because there are some enormous sort of financial institutions, hedge funds, that have been really badly battered and bruised over the last week because they took out short positions on some of these stocks, particularly GameStop, that have really skyrocketed. So I think shorting can be quite a confusing concept to people who aren't really familiar with investing, and in many respects it is quite a confusing practice, especially certain aspects of the mechanics of it. But I will cover that, like I say, in a future video more in depth. But all you really need to know for this section is that when you short a stock, you essentially borrow stock from someone else, you immediately sell it, then you hope that the share price goes down so that you can then buy it back for a lower price, return it to them, and then you've kept the difference. So you short a stock, as I say, when you think that the company's share price is going to perform poorly. And that's what these hedge funds did with these companies, in some cases with good reason in terms of these companies involved, but obviously it has backfired heavily for them. So the reason shorting a company is so risky compared to taking a long position in a company, which just means buying the stock and hoping that it goes up, is because you open yourself up to unlimited losses. So say you bought 10 shares in a company that was priced at $10 a share, you've paid $100, and the worst case scenario for you is that this company were to go bankrupt and you would lose $100, which isn't ideal, probably not what you had planned on, but you've only lost $100. If you short a stock, you are opening yourself up to unlimited losses because there is no limit to where it can go. The limit to where something can go down to is zero, but upwards there is no limit. I mean, Berkshire Hathaway Class A shares cost hundreds of thousands of pounds. So if you had taken out a short position on a stock like that when it was at a low price, you would you would have lost literally probably millions, if not billions, of dollars or pounds, depending on the size of the short. So retail investors, people like you and me, individuals, very rarely take out short positions. Partly for exactly that reason, it's just too risky, and they tend to be taken up by, like I say, hedge funds, and that's why a lot of people over the last week have thought that what they're doing is sort of like a kick in the teeth to these institutions who have behaved perhaps unethically at times in the past, or even in this case, in terms of the manner in which they shorted some of these companies. So that's why shorting a stock is so risky. That's why I personally have never done it, would never do it, and wouldn't recommend it. But that's I'm not here to offer advice, just to explain some of the risks involved with shorting a stock. And also, quite interestingly, one of the consequences of this whole sort of affair is that hedge funds who do often take out short positions may be a little bit more reluctant to do so in the future. They may take out perhaps smaller short positions because the risks are now greater if some people online decide to ruin that position for them, and they may just think twice before doing it at all. They may so that's sort of a permanent change that may come out of what's happened over the last week, but we'll see how it plays out. Now, point number 2 is on the dangers of trading and of ignoring the fundamentals of a company. Now, I think it's important before I say this to stress that there are a number of different people involved in this sort of GameStop and the other companies like Nokia and BlackBerry, the other people buying these companies. Lots of people are just coming at it from the angle of they want to say a big sort of FU to these hedge funds and institutions. And they are saying, I'm happy to lose X amount of money in order to make this point, which is obviously very different to investing, but you might say is a perfectly worthwhile thing to be doing. I'm not talking about those people. I'm talking about the people who most certainly do exist, who are buying these companies thinking that they're making a shrewd investment that is likely to have very good returns. Now, there are people who have done that and have made good returns in this instance, because obviously these companies have gone sort of a little bit mental in terms of their share prices, and that can happen and will happen. And any day trader is likely to have stories of enormous successes over very short periods of time. They will also likely lose lots of money, and in the vast majority of cases, day traders lose more money than they actually make. Roughly 80% of people who day trade from sort of all the data from these trading platforms end up losing money. So, and the reason for that is just because what they're essentially attempting to do is to time the market, and no one can do that in the history of the world. No one has ever been able to perfectly time the market. If they could, they would be richer than Jeff Bezos, Bill Gates, Warren Buffett, and Elon Musk combined. But no one can do it, and that's why day trading is such a risky practice, and again, why that isn't something that I personally have ever done or would recommend. If you want to do it as you might gamble at a casino, again, that's a different matter. And if you sort of put aside, this is money I'm happy to lose, then perhaps you might find some enjoyment in that. Not for me, but so those are the risks, and also the risks of some people who are buying these shares, and what they're essentially thinking is, oh well, it's at this price now, and I can sell it for a higher price, rather than thinking, what am I actually buying? And this is a common misconception with people investing, from both retail investors right up to sort of very well-paid analysts who don't look at the fundamentals of a company. A stock is not just a ticker symbol or a graph. It's a business. When you buy Microsoft shares, you are buying a little bit of the company Microsoft. And it seems obvious, but a lot of people forget that. And in this instance, like I say, there are some people who know that the fundamentals of these companies are not good, but are happy to lose money anyway, or just go along for the ride and consider that money to be, whatever happens, happens. But on the flip side, there are also people who are thinking this is a good investment, and that's why it most likely won't be. And if it does turn out to be, it is essentially luck, and is something that's very difficult to replicate. And if you were able to replicate it, you would be very rich indeed. But I don't know how you would do that. So that's that point, and I'm moving on to point number 3, which is a little bit related, and that is just to do independent research. People have this habit of, I saw Peter Lynch once talking about this as an investor, when they're buying a relatively small purchase, or maybe even a big purchase, maybe something like a dishwasher or a new car, or all the way down to something as small as a house plant or something like that. They'll do a lot of research. They'll look into things like, how often does it need watering? What kind of light does it need? Then they'll look at, well, where's the cheapest place I can get it from? Is this place, I can get it £2 cheaper here. People are very diligent and smart with their money when they're making things like household purchases, or a lot of people are anyway. Then when it comes to something perhaps even more significant, like investments, people will willingly put maybe half of their entire sort of net worth or wealth into something on the basis of someone told them that this was a good idea. Regardless of how smart the person who told you that is, that's unlikely to be a good idea, because even in the unlikely event, I might add, that they're right and this is a great thing to be investing in, if you invest in something and the value of it plummets and you don't know why you bought that asset, then you're likely to panic in that circumstance, and that is when people might sell. So perhaps you might have bought something at say $50 a share, it goes to 25, you panic and sell it, even though that person was right and it is worth maybe $100 a share. The fact that it then goes up doesn't really help you if you sold it and lost half your investment. And that's sort of in the best case scenario that you've actually been given good advice. Obviously, in an awful lot of cases, the advice is not so good. I mean, I saw a tweet from Mia Khalifa advising her followers to buy sort of Nokia and GameStop now. Should probably go without saying, but don't take financial advice from even a close friend or a family member. let alone Mia Khalifa. Not that, I'm sure she's very intelligent, but if you don't know what you're doing and what you're getting into, that's just a bad idea. And it's all part of this sort of FOMO idea, fear of missing out. People see these shares going wild and they panic, and they think that they have to get involved. You don't have to get involved. You can wait it out. You can do your own research. And if you were to think that GameStop was a phenomenal company with great underlying assets, amazing future prospects, and then you were to buy it and the share price were to fall, you would have the confidence to say, yeah, that's just the way the market works, but I know what it's worth and I know where it's going. GameStop, probably not the best example of having that sentiment, but you get the idea. Anyway, point number 4 is just about market volatility. And you'll often hear people say the stock market is volatile, and it is. And whilst this week is sort of a very extreme example of that in terms of these specific stocks, there is a larger point at play, which is that the day-to-day movements of individual stocks, indexes, markets don't always, and in fact very often don't, reflect the actual fundamentals of these companies and of the economy as a whole. Now, there are some people who this week have been saying, in light of recent events, that the entire stock market, everything about it is just wild speculation. There's no sort of fundamental valuations that go into these companies. That isn't strictly true. There's a reason why Apple and Amazon and the like are the most valuable companies in the world. They are extremely profitable companies with very strong moats and business models. So over a long period of time, it tends to be the case that good companies, share prices will rise, well-run companies, and those who aren't and who don't make money, they will fall. But day to day, that isn't the case, as we have seen with a company like GameStop. So that to you, if you were someone who got into investing in individual stocks, and as I'll come to in a future video, that for a lot of people, you will never want to invest in individual companies because there are heightened risks even when doing it well. But if you are someone who's interested in that also presents its own advantages, obviously, because in times of extreme volatility, a company that you might really like but think that's too expensive, when the price falls, it gives you obviously a better opportunity to buy for a price that you might think the market can't justify why it has fallen. Sometimes these things just happen. When COVID first hit, the entire market plummeted very, very quickly over it was one of the steepest declines in history, and obviously it affected almost every company, even though to some companies they weren't impacted by COVID, or were actually positively impacted. Maybe their online services, maybe their stay-at-home businesses, where they're actually going to get more users and more income in those circumstances. So volatility can be scary, can be a bad thing if you're not confident in what you're doing, but it can also present opportunities. And now to point 5, which is a slightly different point, but equally significant, which is that the rules of play are different for retail investors to these hedge funds. And I think a lot of people found that out the hard way, and it's part of a broader point, which is that a lot of institutions and things in life are sort of rigged in favor of those who do already have lots of money. And we saw that with some of these trading platforms that restricted trade. You'll often hear about the free market, which becomes a little less free, it seems, when certain billionaires and hedge funds are struggling. So again, that is a fact of life, an unfortunate fact of life, but it also, yet again, there are ways in which this can be used to your benefit. As a retail investor, we've seen you can be more nimble, more agile. You can make decisions for yourself very quickly. You don't have to justify it to a boss or a boss's boss or a CEO or whoever it might be. And you can weather the storm of a decline. Again, like I say, if you think well, I know that this company is a very good company, or I know that I feel very strongly that this is going to happen. When there is a decline, you might buy more stock, or you might just weather that storm. Whereas if you had a big group of people, or people to answer to, they can push you and force you into certain decisions. So there are ways in which the retail investors and individuals can benefit from these circumstances. But yeah, it's worth noting that the rules do tend to be different. So anyhow, to conclude, those are my 5 points, but I think the biggest takeaway is that there are different people, different actors involved in this recent sort of big short squeeze, in this big story, and they all have different motives, and they all have different legitimate feelings, but perhaps less legitimate reasonings for what they're doing. So, like I say, if you are someone who's doing this just as a fun thing, because it is quite funny what has happened, and perhaps you like seeing people on CNBC panicking and saying, you know, this isn't fair, when obviously nothing that has actually happened is illegal in any way, or perhaps even particularly different to what some of these bigger players do, then that's fine. It is quite funny, and if you say, you know, I'm happy to put £10 or £15 into this stock to go along with that, and you know that there's a chance you'll lose that money, that's obviously fine. A little bit different if you're thinking, well, GameStop's gone up however many 100%, it's just going to keep going up until it becomes bigger than, you know, Amazon. That's obviously potentially not the wisest decision. And again, I'm not offering advice, I'm just hopefully giving people who are beginners and have maybe become interested in investing or aware of investing because of this story, a bit of background and a bit of better understanding. So anyhow, that's it for today's video. There might even this week be a video midweek, because I had actually planned on making a video this weekend until this story came out. So you might get 2 videos this week. Please do hit the subscribe button if you enjoyed today's video and want to see future videos, and give us a like if you enjoyed it. That will really help, particularly with the YouTube algorithms, with us being such a new channel. Thank you, as ever, for watching.